and it gives me great pleasure to have all of you this evening with us. Thank you for taking time from your busy schedule to join us this evening. So before I kind of go into the session per se, just wanted to introduce KLDX to all of you as well. So KLDX is a platform which is regulated by the Securities Commission of Malaysia. We are licensed to do multi-asset tokenization on our platform, which Jeff will allude to later in his presentation. We can also do secondary trading on our platform. And we actually have been in business for the last 2 years. We have brought about many interesting products onto our platform. We did a 50 million ringgit raise for a healthcare company, Integra Healthcare. And currently we're also raising for another company called Cape Renewables. So we are very, very, very pleased to be an alternative platform, which is licensed by the SC to, really talk about, when we talk about financial inclusion, we think of KLDX. We were set up with a vision to actually meet the funding needs and also the funding gap that is identified and that's persistent in our ecosystem. And on one side, also investors, we understand investors are always looking for interesting products where they could make their money grow. So KLDX being a two-sided marketplace, that's been our vision to promote financial inclusion, to make sure that, people who need capital are able to get the capital that they need, and also provide an avenue for people to invest their money and see their money grow. So, so that's a little bit about KLDX. But today, really, we are here to discuss value creation in private markets. So a lot of times people ask us, what is private markets? What's the difference between private market and public equities? And really, this is actually not a novel concept, but in Malaysia, yes, people have been starting to talk a lot more. You might be reading a lot more about private markets. So to dispel, and also to sort of enlighten us on this very topic, it gives me great pleasure to introduce my colleague, who I have a lot of respect and admiration for. So Geoffrey Ng, who's our Chief Commercial Officer. Geoffrey brings with him over 30 years of experience in investment management, capital markets, asset allocation, corporate governance. He has obviously had senior roles across Malaysia, Singapore, Hong Kong, the Middle East. His, very colorful and interesting career spans fund management, private debt, strategic investments, and also, he has played a pivotal role in regulatory education in Malaysia. He does a lot of work with SIDC, as well as being, on the global board of CFA Institute. He has done a lot of work in that, training the next generation of capital market leaders. With his deep market experience and practical understanding of both traditional and emerging investment landscapes, Jeff is well placed to lead today's discussion and also draw out meaningful insights from our session. We'd like to keep the session sort of, so what Jeff will do, he will take us through a little bit about private markets. He has got some slides. He will share with us a little bit of what he thinks, but keep it interactive. There's, of course, the chat box. You can post your questions there, but feel free at any time also to raise your hands if you had a burning question. With that, please join me in welcoming Geoffrey Ng. Over to you, Jeff.
Thank you very much, Winnie. And thank you so much for the kind introduction. I wish that I had the opportunity to introduce you in the same way. Of course, your CV far exceeds mine. So, I'm just hoping for the next platform to be able to do the same. It'll probably take me 10 minutes to introduce you, but, for sure that the next time.
That's very kind of you, Jeff.
Thank you so much.
Very sweet of you.
So today we're going to be talking a little bit about a recap and I suppose a little analysis of markets in Malaysia in terms of how each asset class has done in terms of its historical performance. But more importantly, we wanted to contrast what people are very used to in terms of your day-to-day investment activities, which today I would say focuses more on, let's say, public markets, which includes the stock market, more notably Bursa Malaysia. So, I'm sure there's a lot of statistics out there. I think across the country we have in total about 20 odd million stockbroking accounts, for example. So, of course, not necessarily everyone would have a stockbroking account. Some people may have 2 or 3 or even 5 stockbroking accounts. But by and large, I think a lot of people have accessed their investment activity through public markets, starting with Bursa Malaysia. We've also been investing a lot into unit trust funds. I think around the country we have more than 1,200 unit trust funds that are available for investors to pick and choose from. And of course, we also have increasingly access to some retail bonds, which of course, Bursa Malaysia is also making an active effort. And also some of the wealth management platforms out there give you access into retail bonds as well. So today, we're going to be looking at how public markets have performed, notably the stock market in Bursa Malaysia. We'll also be looking at how some of the private market assets have performed. Some of you I'm sure have gained exposure into some of the more mainstream private market assets, such as private equity funds, or even specific private equity investments into companies, or even venture capital, or let's say Bitcoin or crypto, etc. So these are all asset classes that are considered part of the private markets. We also wanted to touch a little bit about this concept of tokenization, which I think may be new to some of you, but we'll leave that towards the end, in terms of what tokenization is all about and what benefits it brings to the investors in this country. So what we are seeing, of course, is that there is a major shift in global capital allocation. So not just Malaysia, but around the world, we've been seeing a lot of capital essentially finding its way from the regular stock market, increasingly, from bonds as well, going into private investments. And what do we mean by private investments? Of course, private investments are essentially companies which are not yet public. If you see a lot of what had just happened, like let's say SpaceX, for instance, many people have witnessed SpaceX going public the last couple of days, which of course has made Elon Musk the first trillionaire in history. So until 2 days ago, SpaceX was a private company. So as a private company, essentially, very few people would have access into a private market company like SpaceX, just because if in order for you to get access into it, you needed to be either a very large institution, or you needed to be a very high net worth individual or family office in order to get the opportunity to assess and be given access into a company like SpaceX. Private investments, essentially, in terms of the spectrum, is growing rapidly, which we will show you in the next few slides. And also, I think accessibility is also starting to improve because of technological advancements. So as we move closer into, let's say, the ability to invest on a digital basis, we are increasingly getting access into these type of private markets. So KLDX essentially is a company that was built from the ground up by very experienced capital market individuals, like Vinny, who just did the introductions, like myself, of course, the founder of KLDX, who have spent many years in stock exchanges, in fund management, in investment banking, in consulting, etc. Right, where we see the opportunity now to help you essentially move from a more traditional way of investing into a more modern, much more efficient, much more accessible way of investing your hard-earned investment dollars. So we are again seeing a decline in public equity as people get more access into the private markets. We're seeing, as a result of that, private asset growth. And of course, the whole idea here is to gain diversification. Having been a part of the CFA Institute for many years, the single largest, or should I say, the single most important point that we always bring to investment professionals who are coming into the industry, or as we got and advocate, smarter investing, is this keyword called diversification. Because diversification really is the main objective when you're building your portfolio, such that you don't overly focus on one asset class over the other. So you don't put too much money into, let's say, the equity markets versus having some money in the bond markets. You don't put too much money into let's say, the tech allocation, right? So don't put too much of your money into NVIDIA or Microsoft or Google, for example, even though they've done very well, but there will come a day where you could see potentially much higher volatility in the tech sector, which will then, of course, give you some pain and some concern in your investment portfolio. So a long-term investment portfolio is really built around the idea of diversification, that you put your money into many different asset classes, some which are liquid, some which are less liquid, some which are growth-oriented, some which are yielding or income-oriented, etc., such that by and large you get a much better behaving portfolio over the long term. So let's look at public stocks, and this is Bursa Malaysia, as you can see from the KLTI in terms of the top 30 stocks. You'll be surprised to see that even though in the most recent 1 year it's done very well, Bursa KLTI has given us approximately more than 10% return for the past 12 months. But when you then go further back, when you look at the 3-year performance, it's not as great as we think it is. It's only about 7% on a 3-year average return. Go back even further, 5 years, it's even worse, where we've barely broken even. We're up only about 1.3%. And on a 10-year average, it's been really quite a poor performance, only just above 0%. This is before you add in the volatility impact, where you've had years where the Bursa has done extremely well, certain years that it's done extremely poorly. But when you adjust for inflation, which has been between 2.5% to 3% a year, it hasn't really been a great performance, as you can see in this chart here, right? So if you've been investing only in the top 30 index stocks in the last 10 years, you've really gone nowhere in terms of your returns. Then let's look at the volatility that I just mentioned earlier. So you could see that on any given year, you could have, on average, the stock prices go up on average 8% a year, or go down 8% a year. And this is assuming you've had 30 stocks in your portfolio. If you were more of a stock picker, where you would listen to, or you would analyze certain specific companies, and you would put in your portfolio maybe 3 to 5 companies, your volatility would likely have been a lot higher than this 8%. Could have seen certain years where you were gaining 15-20% a year because some of these stocks did very well. Similarly, you could have seen a minus 15 to 20% a year type of return if your stock picks were not so good. On a risk-reward basis, for the amount of what this 0.52 number shows, it basically tells you that for every amount of risk that you take, what was the percentage in return that you actually got. So it's not great. You only got 0.5% for every amount of risk that you actually took. And as you can see here, because we are a fairly smallish market in terms of where the global equity markets are, we tend to be victims to a lot of what we call global fund flows. Fund flows, or also known as hot money, essentially would be episodes where you see a lot of foreign liquidity or foreign portfolio money go in and out of markets. Malaysia is such a country where we are small enough that we get impacted by big amounts of movement as global fund managers move in and out of our markets. So because of that, we tend to see fairly high volatility, especially at times of great uncertainty, such as recessions, or during the COVID period when we first started, for example. If you take our markets on a 10-year type of window, the worst time that we've had a 10-year period was at minus 35.6%. And this really came about 20 years ago during the Asian financial crisis, when we saw significant pain in the stock market as global fund flows moved out of our markets. right? And of course, that was the time when the ringgit also first hit the 4.8 figure to the US dollar. So are bonds safer? Definitely, of course. But you can also see here that bonds also offer fairly poor returns before inflation. So the bond market itself is very large. The Malaysian bond market alone has got a size of more than 2 trillion ringgit. It's a very stable market. It continues to grow. Why? Because the government of Malaysia continues to increase its borrowing into the domestic market to fund its programs, to fund its infrastructure, etc. But as you can see here, the yield that the government is paying, or the return that it's paying investors, is not great. It's only 3.62% for a 10-year paper. So what does this mean? It means that if the government comes to you and it wants to borrow from you, it is willing to pay the investor 3.6% for a 10-year loan. So essentially, if you lend the government 1 ringgit of your hard-earned savings, the government is going to take it, going to keep it for 10 years, and in 10 years' time, they'll pay you back. But every year, they're going to pay you 3.6%. So you think to yourself, is that really great, right? Every year, I'm earning 3.6% from the government. Then you say, okay, I'm not interested in the government. I want to go into the corporate sector. I want to borrow from the likes of Maybank or CIMB or Sime Darby, etc., right? When you go into the corporate, they are paying you not necessarily 10 years, maybe 5 years. If you borrow if you lend to these large corporates, they will pay you maybe 4% at max for a 5-year paper. Okay, so again, you have to ask yourself, is it really worth the effort, or in terms of yields, to lend a top Malaysian company for 5 years and get about 4% return? And for those of us who are even more risk averse, for example, we say, oh, my money is safe in FD. I'm just going to keep it there. The FD rates range between 2% for very short term, whether it's a week or let's say a month's worth of fixed deposit. But we put it away for a year, for 12 months, you probably earn maximum 3.5% return per annum. Now, all of these figures, the 3.6%, the 3.95% for top quality companies, the FD rates that you see here are before inflation. Okay, so if you adjust for, let's say, inflation coming in at about 2.5% or 3%, and I can guarantee you that this year, 2026, you're probably going to see inflation go above 3%. Why? Because of the war that that was ongoing, which has of course impacted us in terms of much higher fuel prices, even despite the fact that we've got some subsidies from the government. But by and large, you will see some amount of inflation coming in. So if let's say you take this year at 3%, your net return, if you were invested in any one of these asset classes, would be just above 0%. So maybe 0.5%, maximum 1% is what you'll probably earn this year. So again, you have to ask yourself, is it really worthwhile putting all of your money into bonds, even though they're very safe, for example? But again, does that build your wealth and your net worth over time if you were fully in bonds? So of course, given the fact that on the public market side, we've got equities that, as you can see, over the last 10 years hasn't really given fantastic returns. We've also seen bonds not really give great inflation-adjusted returns. So this is why we have seen a lot of assets move more and more into the private markets. So since the year 2020, around the time of COVID, we have seen significant amounts of growth in the private markets. On average, every year, the private markets have been growing in excess of 20% a year to more than 300 billion about 3 years ago. Where have they been going into in the private markets? They've been going further into private equity. They've been going more into venture capital and also private credit, etc. So we're going to spend a little bit of time talking about that. But just taking a nuance or an indicator in terms of what the big funds are doing, the EPFs, the QOPs, the Tabung Haji, LTAT, etc. Every year that has gone by, they've been gradually increasing their allocations into the private markets. Why? Because number one, potential returns are higher. Number two, it's a great form of diversification of their overall portfolio to their investors. And of course, number three, there's greater liquidity that's starting to go into private markets. So what is private equity? I think for those of us who may not be too aware of it, private equity essentially is investing into the equity, or should I say the shares, of companies which are not public. So these are companies which have not gone onto Bursa Malaysia just yet. Or it could also be investing into the subsidiaries of public companies that have already traded on Bursa. Right? So we are going into companies which are probably less liquid in terms of your ability to get in and out of these companies, but who could potentially be much higher growth in terms of their potential if given the right amounts of capital, and also, of course, being in the right industry at the right time. So we have seen that on average, historically, the average return on private equity has been about 11% a year on average over a 5 to 7 year period. The focus has in private equity in Malaysia has been more on the retail side. So think about the likes of Mr. DIY, Speedmart, should I say 99 Speedmart, and I suppose the up and coming BIG, the big pharmacy group. These are all focus points of private equity that are active in the retail segment. Okay, and then of course we've got education groups. We've got Help Institute that is working on the IPO fairly soon. They used to be public, they went private, now they're coming back again. And of course, you've got finance as well. There's a lot of private equity, mostly focused on payments, and I suppose even e-wallet providers, etc. So the whole idea of private equity really is to bring professional investors into a private company to help them grow the business, and also to help them grow governance and strategy around these businesses. So the end result of that is that you could have much higher growth companies as you invest into these private companies that could potentially, over time, exceed the returns that you'll get in the stock market. Of course, then you've also got venture capital, and VCs essentially are people who are looking at probably earlier stage companies, right? Companies which have got very good business models, very good business strategy, need capital in order to really grow and to scale, and to basically scale their business. But these are normally high growth tech-based companies, with the right management team, with the right guidance, with the right market and the right placement and positioning that they're in. These companies could grow fairly quickly. Okay, so these are mostly newer tech companies. Of course, they also come with high amounts of risks. And venture capital, the strategy really is to spread your investment money to as many companies as you can, because the failure rates, or the risk of failure for each company is potentially quite high, but then the risk of upside is also very high. So how a lot of venture cap companies work is that they would invest in a fairly large portfolio of tech companies with the hope that those who do very well will exceed those that don't do well at all, or those that essentially do not make it, right? So they will have some failures in the portfolio, but your hope, of course, is that those who succeed, the returns will far exceed the amounts of those that have failed. So we've seen close to 7 billion ringgit worth of money go into Malaysian startups since 2023. Okay, and therefore, in the private markets, venture cap is also growing quite steadily. And of course, the government is also very active in supporting these VC companies through government entities like MAVCAP, Cradle, so on and so forth. So, we're also getting a lot of government help from there. We're also seeing a significant amount of activity in private credit. So what is private credit? Essentially, it is access to loans which are not provided by banks. So that's the simplest way to provide it or to explain it. So companies which do not have access to bank capital, because banks see them as too risky, there's not enough security or collateral to give a loan, etc., may actually move into the private credit space in order to get funding. So there are a lot of players out there today that provide private credit funding. You've got the P2P players. Even some of the smaller banks have gone into the SME market to provide more lending, etc. So we're seeing a huge amount of growth in terms of the private credit markets. And, as I mentioned earlier, it's now close to 7 billion worth of funds that have gone into funding SMEs. The yearly profits or the returns that have been achieved through private credit ranges between 7% to 12%. How do they differ? The 7% private credits are normally those that go into better known SMEs, those with a brand name, who've got good cash flow, etc. And of course, those that have got good security in terms of assets. So it could be a cash flow security, it could be an asset security, it could be an equity security, so on and so forth. Now, of course, it goes up the curve to 12%, which could potentially be more risky investments. Things like, let's say, invoice financing, and so on and so forth. So, the rate of return that comes in on an annual basis into a private credit investment would really depend on the amount of risks that you're exposed to as you invest in that private credit. So hence the difference in terms of the total returns. So why do investors increasingly look at private credit? Or should I say private markets? I apologize for that. Investors have essentially more control when they decide on the companies that they invest into. So if you're large enough as an investor, you can exert a certain amount of influence on the companies that you're investing into if they were private companies. Compare that to, let's say, a public company where, unless you're a very large shareholder, you've got representatives on the board that can help to influence, I suppose, how the company behaves. Public companies generally tend to allow investors a much lower degree of influence compared to a private market company. You probably will be able to sleep better at night if you had some of your money into private markets as well. Why? Because you're not exposed to the volatility of asset prices like you would in the stock market. So as mentioned earlier, we've had years where the markets are up and down 8%, so that could cause some people some amount of concern. But in the private markets, things tend to be a lot more stable. Why? Because we don't see daily prices every day. Okay? And as a result, that probably from a psychological point of view, there's also less concern in terms of how prices are moving. And of course, it is true private markets, as I mentioned earlier, that you may be able to get access to some of the new high-flying companies, right, in the future. So we are seeing a lot more opportunities now through platforms like KLDX that potentially give access to new pre-IPO companies as they are scaling themselves prior to an IPO. So, we, of course, are working hard to be able to access some of these names as well for our investors. There's also, of course, the issue about why private markets are challenging to get into. Oftentimes, private markets tend to require a certain degree of lockup of your investments. It could range between 5 years or 7 years or even 10 years. So if you wanted to sell your private market investment, sometimes it's quite difficult just because of these lockup requirements or because markets are not so liquid. The other issue, of course, is accessibility from the perspective of size. Private market opportunities used to be the domain of only very large funds or large high net worth individuals, but we're starting to see greater amounts of democratization. The concept of things like tokenization comes into play, where we are able to fractionalize or to bring it into much smaller sums, such that smaller investors will be able to participate as well. So again, it's giving access to a much wider audience that used to be only the domain of, let's say, the ultra rich or the more the people who have access to such great opportunities at the expense of others. So let me introduce to you for those of us who are, I suppose, less aware of what tokenization is. As I mentioned earlier, tokenization is really the concept of taking large assets, applying a digital layer on top of it, which essentially means that these tokens represent a certain portion or proportion of the underlying asset. So if I took a let's say a Malaysian government bond, an MGS security, which normally trades in the open market at 5 million ringgit per lot, by applying a token layer to this MGS, I could basically break it down into multiples of 100 ringgit or 500 ringgit or 1,000 ringgit, such that people who couldn't afford buying a 5 million ringgit lot of MGS will now be able to access the MGS at much smaller amounts. By then allowing these tokens to trade on KLDX, for example, through the secondary market, investors will then be able to buy and sell these tokens amongst themselves, which then gives you liquidity, right? Because if you only had, let's say, 1,000 ringgit worth of MGS, you can't go into the banking market and sell it to the banks. It's too small for them. So by allowing us to then trade on KLDX, for example, we hope that there'll be buyers and sellers that will be able to trade these MGS tokens as we go along. There's also a common misconception that tokenization is the same as cryptocurrency, such as Bitcoin, like Ethereum, etc. So we need to demystify the fact that tokenization is not the same as crypto, because a token has an underlying asset attached to it. And the asset is normally a normal, traditional asset. As I mentioned earlier, it could be a bond, it could be a stock, it could be a fund, it could be a commodity like gold or silver. It could even be real estate. It could be like a condominium building that we essentially break into smaller portions. So that's the key difference between a token and a cryptocurrency. A cryptocurrency like a Bitcoin or Ethereum does not have any collateral. There's no securities underlying that, right? So because of that, crypto could potentially be a lot more volatile, because we don't know what the asset value. We really don't know what the value of a crypto is, because there's no underlying asset to it. We compare that to an MGS bond, that if you build a MGS token, you know that you have an MGS or a proportion of the MGS that backs that token. So as a result of that, we know there's some value in that token. Just again, to try to differentiate the common misconception that a token is equal to a crypto asset. It's not the same, because a token has an underlying asset backing it at all times. So how does tokenization really solve the issue of private markets? By being able to tokenize it, we are able to, as I mentioned earlier, fractionalize or bring a large asset to a much smaller bite size, so that everyone can participate. Just like what 𝐻𝐴𝐺𝐴 did to aviation, where everyone can fly, KLDX is now able to let everyone invest into much larger assets than what we could before. We also, because of the fact that we use what we call a blockchain technology, we are able to digitize a lot of the process of investing, right? So everything happens on a digital basis, and it happens immediately. So if you, let's say, went to Bursa Malaysia and you bought a stock, it will take you T+2 days to settle your stock. So if you bought it today, on Monday, you could probably only settle it on Wednesday. With the likes of KLDX, all of these transactions happen instantaneously. Why? Because we have the platform that is already all digital, that happens to, that is able to support this type of immediate settlement. So this really takes away a lot of wasted time. It takes away a lot of potential loss in terms of interest income, because of these 2 days that you had to wait for a settlement on Bursa. You could have actually earned interest on those 2 days. Okay, so similarly for here, because of the fact that it happens instantaneously, you do not lose the interest portion that you would have lost on other exchanges. Because of the fact that we also have secondary trading, you can also easily sell your shares to other investors on a very safe basis on KLDX. So tokenization is already at our doorsteps. In the US, for example, before I touch on Malaysia, the token markets there are in excess of a few $100 billion already in terms of their overall size. Over here in Malaysia, we're just starting to take baby steps, but you can see that momentum is growing rapidly. Just a month ago, Khazanah, our national sovereign fund, had issued a 100 million ringgit sukuk, or an Islamic bond that was tokenized. Okay, we are working, of course, with some banks as well here in Malaysia to tokenize some of their bonds as well. So please look forward to that. That's coming very soon. But KLDX has also achieved quite a bit of success recently, where we were the world's first Islamic healthcare private credit token investment note that we had launched. And also we just recently launched the first renewable energy private credit investment note, which I think Vinny had mentioned earlier, is Cape Renewables. Right. So again, just to touch a little bit on that, Cape Renewables essentially is a renewable energy company that is focusing on bringing solar solutions to the industrial market in Malaysia. So think of factories, think of data centers, think of commercial buildings that want to solarize their energy consumption in order to not just incur savings in terms of their power consumption, but they would also be looking at attaching batteries to these solar solutions in order to save even more money in the future. Why? Because Tenaga Nasional, of course, our national utility, is now starting to charge much higher rates to consumers who consume electricity at peak periods. When electricity consumption is very high, if you were a factory and you used that electricity at that period of time, you probably pay a lot more than if you were to use it in the quieter periods, like let's say at the wee hours of the morning, etc. So a lot of these, we're seeing a lot of demand from factories, from industrial users, essentially to implement such solar solutions with batteries attached to it, such that they can consume their electricity a lot more efficiently. They will be charging their batteries when it's cheap to charge it, and they will be draining the batteries for their factory use when it's very expensive to use it, right? So we are hence raising money for companies that provide such solutions. So really the concept of tokenization is to introduce a lot more asset classes to investors that potentially could have higher profits or higher returns, which are more diversified than what you have access to today, which you could probably get from the stock market or from the bond market. We are introducing a lot of newer ideas and newer investment opportunities to the average Malaysian. So this is the final slide. Why KLDX? KLDX again is a future-proof platform that of course is licensed by Securities Commission Malaysia. We have 6 licenses. We are multi-asset, so we cover all types of assets, including private credit, which I just mentioned about, the more traditional bonds and sukuk. We do a lot of new equity ideas as well. Funds. So we are bringing in fairly challenging to access funds. We are working with some fund managers to bring into the market. We also will be facilitating commodity exposures as well as finally real estate. As mentioned earlier, we are blockchain native, so we bring a lot of efficiency and speed to transacting and to investing. Of course, we would also like to focus on the fact that we are leaders in Sharia private markets going forward. So I think I've talked enough. I think I've been speaking for about half an hour now. So I think I'll pass this back to Vinny for a Q&A session. So Vinny, thank you very much.
Thank you very, very much, Jeff. I certainly found it super, super interesting and very insightful. I mean, you shared a lot of insights. I mean, it was really a masterclass of private markets. And I certainly learned a lot. And I think you shared a lot of interesting data points. And I think there was also a lot of, I suppose, insights into the products, which make up private markets. So I really certainly found it very insightful. I will open up the floor for any questions that we might have for Jeff. You can put it into the chat box, or if you prefer, you can also sort of raise your hands and fire away. Okay, so I'll start. So you spoke about sort of peer-to-peer lending, private credit. Obviously comes with higher returns, but they also obviously come with the credit risk attached. From your perspective, what should investors look at before investing in private credit opportunities? What are the top 3 things that they should be looking at?
Well, I think the top 3 things that a private credit investor should look into is, number 1, I suppose the cash flow ability of the company, right? I mean, because it's private credit, they probably would likely need to pay a higher rate of return. So in order to offset that higher rate of return, of course, it comes with additional amounts of risk. So how you would probably want to assess that is essentially how much security or protection this company is able to give you. So they could come potentially from cash flows. So like to use the example of KLDX Renewables, for example, why we liked the idea of bringing KLDX Renewables to the platform is because these were all essentially project-based cash flows. So they would essentially identify a project. We would look at who the project owners are. So who are the owners that they are implementing the solar solutions for? Are they credible? Are they bank worthy, right? In the sense that will they be making the payments to KLDX Renewables as and when these projects are completed? We will also assess what other further levels of security we'll be getting. So in the case of KLDX Renewables, because it is a subsidiary of a public listed company on Bursa, a main board company, who was also willing to give us a guarantee on any potential uncertainty that happens to KLDX Renewables. We also took that as an additional level of security as well. So again, it's always a balance between how much you're getting in terms of return and how are you able to manage the downside risks associated with obtaining that return in private credit.
Thank you, Jeff. Thank you very much for that. I do have one follow-up question, if I may. From your experience in fund management and capital markets, and you've been, you have seen the evolution, right, and the growth of capital markets, and especially fund management in Malaysia. And what is the biggest mindset shift you think investors need to make when sort of, traditionally we've been very exposed to public markets, and now sort of, looking at private markets? What do you think, investors need to do?
So the mindset shift really starts with whether you're seeking different opportunities for making a return. I mean, I think we've already demonstrated that the mainstream asset classes like stocks and bonds have not been able to give very attractive long-term returns to investors. So if you are looking for, let's say, additional amounts of return in your investment portfolio, whether it's for education purposes or for retirement or for health planning, etc., if you're looking for higher sources of return, you may want to look at allocating some of your assets into the private market space. And we're not advocating that you put all of it into the private market space, but at least increase the amount of allocation that you may want to put into private markets. And this is not different from the likes of, the investment committee or the board of EPF, for example, who have been essentially thinking about this for many, many years. And as the years go by, you would see that every year a larger allocation of their assets is gradually put into private markets. And it's not just because they're looking for higher returns, it's because they're looking for a more balanced portfolio over time, a more diversified portfolio over time. We've all heard of this concept called correlation, right? If markets are all moving together in the same way, then you would see higher volatility in your investments. But if you put your assets into asset classes which do not follow each other in terms of the behavior all the time, then you will get a more well-behaved, less volatile portfolio over time as well. So this is really what private markets will be able to bring to a public market portfolio.
Yes, thank you, Jeff. Just like to see if there's anyone else who had any questions. We are going to hit the 9 o'clock mark very shortly too. So if there aren't any questions, thank you again to all of you for joining us late into this evening. And if you have any questions, feel free to reach out to us. I also would like to invite you to go to our website and just try to, sort of log on and see. And I would like to, urge you to look at the opportunities on our platform, try it out, share with us your feedback. And, with this way, we grow the investing community in Malaysia, and also to share, what opportunities are out there. A lot of times people ask me, where can we put our money to work for us? Sometimes people just don't have the access to these opportunities, as what Jeff was saying, right? A lot of time it's sort of because private markets have been very private for a reason, right? It just falls into the sort of, segment which has access to these interesting opportunities. But our role here as KLDX is to actually democratize access to these interesting products. So do feel free to share also, with your friends and your family. With that, thank you, Jeff. for sharing
you.
with us your insight, and good night, everyone.